Hey everyone, hope you're all doing well out there. This is your August market review. So the reason that I put these videos together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this ultimately is to give you the information about what's going on in the stock market and the economy, and then how that affects your money. Stocks for the month of August were down across the board after being up sharply in July. The S&P 500 was down about 4%, which was a little bit of a give back of what it had made in July, being up 9%. So the slide continued into the first few days of September here. I'm shooting this here September 8th. So yesterday the market was up on September 7th. Today it's looking like it's up at least so far. So positive signs of maybe a little bit of a turnaround after Jerome Powell spoke about raising interest rates here later on this month. So a few charts that I have, and for people that haven't seen these before, these videos that I create here, I put these out each month, obviously because I want to give you that straightforward information, but also I use a lot of charts so that way it's something that visually you can soak in the concepts that I'm talking about, because otherwise financial concepts can be kind of pie in the sky type stuff. So I have two economic charts that I'll talk about, and then three stock charts that I'll talk about, and tie that into your guys' portfolios, at least the ones that I manage, and we'll dive in a little bit more from there. So first chart that I have is the unemployment rate for going back here over the last couple of years. It shows on there the current unemployment rate as of August, which is 3.7%. Still actually close to a 50-year low as far as the unemployment rate goes. It's also right back, or right at that level of the pre-pandemic low that it was at, obviously before COVID had kicked off in 2020. So this is important because one of the reasons that the Federal Reserve is increasing interest rates, the main reason is to combat inflation, which the concern would be is that pushes us into a recession. Unemployment is a lagging indicator in a recession, so we may already be in a recession, and which is very much so up for debate right now. But as of now, even though there's been two negative quarters of GDP in the first and second quarter, unemployment still hasn't really gone up. So for those of you that don't know, I don't want to throw out like the economic jargon. GDP is the measurement of, it stands for gross domestic product. It's the measurement that the government uses to see how much we produce as a economy. So if it's positive, that's obviously a good thing. When it's negative, not a good thing. 2 quarters in a row of negative GDP growth, typically it means that we're in a recession, which is what we had in the first and second quarter of this year. But that's not officially a recession. It's just typically what a recession would be. There's a board that ends up actually saying officially if we're in a recession, which a recession is always a backwards looking thing. So we never know in the moment that we're in a recession, typically, that we're in a recession. COVID was a little bit of a different scenario because the entire economy just shut down, so it was a given that we were in a recession at that point. But typically that's not the case. So unemployment, though, is a key factor that's looked at when we're looking at a recession. It's really tough to say that the economy is doing terrible when people can just get a job whenever they would like to. So, and that unemployment is super low, which brings me into my next chart, showing the, I call this the job switcher chart. So in the orange line there, this goes back all the way through 2000 and through today, or at least through July. People that wanted to switch jobs, or did switch jobs, got paid 8.5% more to switch jobs versus people that stayed at their job. They still made more, but they made only about 6% more. So the overall, number is a little bit closer to 7. So this is, I thought, a very interesting chart to tie into the economic picture of where we're at right now, because if somebody decides that like, hey, I don't like working where I work, or I could go work somewhere else and make more money, that's a really good sign that the economy is doing really well, because that means that those companies are having to pay people more money. keep in mind that inflation is still at like 8.5%. So, that person that's switching jobs and their income has increased by 8.5%, that's basically them just keeping pace with general inflation. People that are staying at their jobs, statistically speaking, are actually not making as much money or not keeping pace with inflation because their wages haven't gone up as much. So, but this is a really good sign that the economy is still pretty healthy, at least from a labor standpoint, because unemployment's lower and people are getting paid more to switch jobs versus the people that stay at their jobs. So I thought that was an interesting little tie-in there of kind of the state of the employment part of the economy, even as they raise interest rates. So I got 3 different stock charts that I'll hit through here to talk a little bit more specifically about client portfolios that I manage, and just give you a little bit better of a general overview of what's going on and my thoughts really on it. So first chart I have here is showing the S&P 500 performance year to date and all the gyrations that we've had throughout the year. The market is down about 17% as of today. This is printed out, September 8th, about 12 o'clock. So it's down about 17% for the year at the moment. It's been down at most about 24% on the year, which will tie into another chart that I have in a couple slides here, a couple charts away. But we're off of the lows of the year. We're also off of the more recent highs that we had back in the middle of August. So there's been a lot of volatility. And the reason I wanted to bring this chart up is just to show a couple things. Number one, that the movements that have gone on here this year. So that way, for those of you that are literally looking at your portfolio every day, or for those of you that wait until we connected to look over your portfolio, there's been a ton of fluctuation, which stocks are always moving every single second during the day. But this has been a more volatile year overall of ups and downs than historically that we've had. But it's also, the main reason for this is because the overall stock market is looking at, well, are we going to be pushed into a recession? And is that going to be because they raise interest rates too much? And then by they, I mean the Federal Reserve. And the reason the Federal Reserve is doing that is because they want to bring inflation down. And that's the textbook economic way to bring inflation down would be by raising interest rates. So stocks are a forward-looking indicator of what the economy is going to do. So they're trying to predict, investors are trying to predict what is going to happen to the stock market in the next 6 to 12 months. So if we look back to mid-June when stocks were down 24%, the economic picture was looking pretty grim at that point because of how much they were talking about increasing interest rates, and really the fact that inflation at that point had still been going up. So it had hit that peak in around that mid-June spot, which then all of a sudden we had this rally in the stock market because of that. And that's when you saw gas prices went from $5 a gallon down to where they are now in that mid-3 range. So that's the easiest way if you're looking at just one aspect of inflation. Gas prices are one of the larger parts of inflation. It's not the thing that the Federal Reserve looks at, because the Federal Reserve actually looks at core inflation, but that's a little nitty-gritty than what I care to talk about in this video here. So next thing I'll bring up is a chart here showing the Bloomberg Global Aggregate Total Return Index. So this is for the bond index. So this is if you're investing in bonds, this would be like the index that you're looking at to see, well, how is the bond market doing? So it's just like if you're looking at, well, how are stocks doing? I always look at the S&P 500 just because that's a larger amount of US-based stocks. So if we're looking at this, it's recently gone into what's called bear market territory. That's when any stock or index, whatever it may be, drops 20% from its high. So it goes through 20% down. So the peak of this was way back in the beginning of 2021, and we just recently, hit a bottom here, or at least, the more recent bottom. It could keep going lower. One of the reasons why I bring this chart up is that traditionally, especially for those clients of mine or more conservative investors out there, if you're a more conservative investor, traditionally you're going to have money invested in bonds. So there's what's called a modern portfolio theory, where you'd want to have 60% in stocks, 40% held within bonds. And the rationale behind this is that bonds will offset some of the volatility that happens within stocks, and that when stocks are going down, bonds go up. So this was all based on the modern portfolio theory that Harry Markowitz, a Nobel Prize winning economist way back in the 1950s, it was like 1954, won a Nobel Prize for this research. So we fast forward to today, and it's very widely used by many financial advisors, investment managers out there, as far as how they construct portfolios of 60% stocks, 40% bonds. So again, not trying to give you a little history lesson there, but not trying to go into the weeds too much with that. But one of the reasons why a little over a year ago I cut bonds completely from all clients' portfolios was because of where interest rates are at. Obviously, hindsight 2020, looking backwards, it was a good move to do that because of where bonds ended up falling here over the last year and a half. But the reason that I did that at that point, and the reason that I continue to not have bonds in portfolios right now, is because of interest rates going up. So it was almost clear that they were going to raise interest rates at some point over a year ago. That it was, they weren't necessarily talking about doing it at that point, but at some point they were going to have to raise interest rates. Inflation still wasn't a major concern for them. They were still actually at the time, last summer of 2021, they were still actually at the time concerned about how COVID would affect the economy and new waves of COVID would affect the economy. So they didn't want to take their foot off the gas pedal as far as helping stimulate the economy with keeping interest rates lower. But, as an investment manager and somebody that's managing, your money as a client of mine, one of the things that I have to look at is what is likely to happen and really where the risk's at. So what I did is I moved a large portion of that money into buffered strategies, which buffer against stock market drops and participate to a degree on the upside with stock returns, which those are also down to a degree this year, just not as much as bonds are. So depending on the buffer and the timing and all of that good stuff. So, but that is, what I've done with more conservative portfolios, or for those of you that are trying to, hedge the risk within stocks, was using more of those buffered strategies that have options inside of them to help, mitigate some of the risk. So I thought that was an interesting chart just because that is such a widely held thing. If you have, for those of you that are watching this that aren't my clients, if you have a 401k and you're in a target date fund, which simply you can look at this, and if you look at your 401k plan and you're in something that says like retirement 2040 or retirement 2030 or target 2030, that's what's called a target date fund because it's based around your age and your target retirement date of when you would be like 60, 65 type of thing. In that case, you 100% have some bonds within your portfolio because in that mutual fund, there are bonds held within there, and actually similar to what this Bloomberg Global Aggregate Bond Index would be. So if you have questions about that and want to talk to me, happy to talk with you about that. But that's why I wanted to bring up that chart, was because I think that this is, a lot of people think that bonds are super conservative, and they are traditionally more conservative, but when you're looking at just the fluctuations that they can take, bonds can be, actually just as volatile as stocks, depending on what's going on in the interest rate world. So the last chart that I have here is a chart that I've actually used. I think I used it actually back in June, and it's a chart that shows the S&P 500 returns in a recession. So this goes from the top of the recession, or where the market was, before the market started sliding, to the bottom of where it got to during the recession. So going all the way back, this data is, looking at years all the way back through World War II. So in the top spot there, you see 1960 down about 14%, so on and so forth, all the way to 2007, which was the worst recession that we've had since World War II, and the market was down 57% from 2007 through 2009. That was what's referred to as the Great Financial Crisis. Before that, we had the 2001 recession, where stocks actually started falling in 2000 when the dot-com bubble burst and dropped all the way through 2002. Before that, in the 1970s, we had 2 recessions, both caused largely by high inflation at that time. We had 2020, which was obviously the COVID recession, and then a number of them that were smaller. So the reason I bring this up was because if we look at the very top of the chart, it shows that stocks have fallen a median of 24% in recession since World War II. So the median just so happens to be the exact drop that stocks had fallen this year. So since the peak in the very beginning of the year. So we're down, like I said, about like 17% for the year right now. At most, we're down 24. So we're not technically in a recession. Now, if we fast forward 6 months and they come out and they say, hey, we were in a recession actually for the first couple months of the year, or the first couple quarters of the year, then all of a sudden 2022 would become part of this data set, and you'd see that in there down 24%. So that would be if stocks didn't continue going down. Actually, it'd go down further than 24%. So I like this chart though because it puts in perspective really what a recession is, and the reality of stocks dropping so dramatically that's not a norm during a recession. Stocks don't have to drop 50% during a recession. Like, the great financial crisis from 2007 through 2009 is definitely an outlier because there was a lot of different things that led into that. So there was the credit crisis, there was the real estate bubble bursting, all happening at the same time. Not the case today. Obviously there could be a recession for a completely different reason, or something more dramatic for a different reason than what happened in 2007. Typically, recessions don't have the exact same reason that they happen, but a lot of times they can be caused because of events that happen like COVID, or it can be more financially related like what happened in 2007. Those are typically the 2 reasons that recessions do happen, or events, or financial markets themselves. So, but this was brought up, and I saw this again, and I was like, well, this would be a good chart to talk about because people get a little freaked out when they're looking at their portfolio down, like it's been down this year, regardless of conservative, aggressive, wherever you're at. Just keep in mind the big picture. So stocks don't stay down forever, and they do, though, historically, they do go down, and they go down during recessions. But a drop of 20% means that you need a 25% return just to get back to even. So we've already seen those types of rebounds happen, where from the bottom of the market being down 24%, the market then rebounded 21%, and wasn't flat on the year, but was not down as much in the middle of August here. So then we've seen the slide off since then. So there's always going to be volatility within stocks, and that's the reason why over time you make more money investing in stocks. So all of you that are clients of mine are longer term investors. So it's not like we're looking to take all of your money out of a portfolio and use it all within the next 6 months. This is, for most of you, retirement money that you're going to slowly take out over the course of your retirement. And a large part of it should be held within stocks, because stocks are going to make a larger amount of money over time. So, and that's been historically proven over the last century. So if you have questions or would like to connect to go over any specific things within your portfolio, don't hesitate to reach out to me. Call, text, email, whatever you prefer in that way. I'll be happy to link up with you and set up some time to talk more from there. But I appreciate you all taking the time to check me out. Until next time.